For generations, there was this golden rule in investing. Just find a solid, dividend-paying company, and you could sleep soundly for decades. But what if that rule is now, well, dangerously outdated? Today, we're going to tear down that whole idea of the safe stock to figure out what safety really means in today's market. Because the answer, it might just surprise you. I mean, just let that sink in for a second. The very stock you bought for peace of mind could be the one harboring the biggest risks. It's a pretty wild thought. But as we're about to see, it's a reality that has blindsided countless investors. So to really get how we got here, we've got to look back at the original concept. So let me introduce you to the Widow-and-Orphan stock. Yeah, the name itself kind of says it all, right? This was an investment so reliable, so fundamentally sound, that it was meant to provide for people who just couldn't afford any risk. We're talking about the bedrock companies, in essential sectors like utilities or consumer staples. You bought them, you collected the dividend checks, and you never had to worry. At least that was the story. All right, so that brings us to our first section, where we're going to dive into this golden age of buy and forget, a time when the market really did feel a lot simpler, and certain companies seemed, well, truly indestructible. So this whole idea of a safe stock, it wasn't just some casual preference, it was actually baked into the law. Back in the 19th century, this prudent man rule basically required the people managing money for others to preserve capital above all else. This kicked off a search for unshakable assets. And by the 1930s, AT&T became the poster child. It was a monopoly, everybody needed a phone, and it famously never cut its dividend, not even during the Great Depression. But then, the 1980s. The breakup of AT&T was a real wake-up call, the first major sign that even these giants could be broken apart. And this quote, I think this really gets to the heart of it. For decades, investors didn't see these as volatile stocks. Not at all. They saw them as reliable income generators, kind of like bonds, but with this awesome added bonus of the stock price potentially going up. This was the core appeal. And, as we're about to find out, the central illusion. And this? Wow. This just drives the point home. If you had built a buy-and-forget portfolio with the biggest, most dominant companies of 1925, we're talking leaders in stuff like sugar refining and railroads, well, you'd have been pretty much wiped out. Only a tiny fraction of them even survived the next 100 years as a real investment. The idea of permanence? It was always a myth. Okay, so now we're going to see how this myth didn't just, quietly fade away. Nope, it absolutely shattered. We're going to look at some very modern examples where the old guard of safe stocks just collapsed, leaving income investors completely devastated. All right, let's talk about Walgreens. This was a classic defensive stock. A retail pharmacy seemed totally immune to the ups and downs of the economy. It had this incredible track record, 47 straight years of raising its dividend. And then, poof, it all just fell apart. A nearly 50% dividend cut in early 2024, and then a complete suspension just a year later. The reason? Perilous financials. And look, the damage wasn't just the dividend check. The stock itself. Over 5 years, its value just cratered by 75%. That is a catastrophic loss for anyone who bought this stock for safety. It really shows you how quickly a reputation built over decades can just evaporate. So what's the big lesson here from the Walgreens story? It's a tough one, but it's so important. A company's glorious past means absolutely nothing if its current business is broken. A long dividend streak can actually hide some really serious underlying problems, like bad business moves and huge legal bills, which is exactly what happened here. And believe me, Walgreens was not some isolated case. The original safe stock, AT&T, had to slash its dividend by almost half in 2022. Why? It tried to become a media giant, took on over $200 billion in debt, and it was a spectacular failure. And then you've got General Electric, whose downfall came from super complex accounting that hid massive problems for years. The common theme here? Once great companies that just lost their way. Okay, so why? Why is this happening now more than ever? Well, a huge part of the answer lies in a massive economic shakeup back in 2025 that basically rewrote the rules of the market. In mid-2025, this huge piece of legislation, called the One Big Beautiful Bill Act, or OBBBA for short, it changed the entire game. As you can see here, its different parts were all designed to supercharge domestic manufacturing and growth. Things like 100% bonus depreciation basically told companies, hey, go spend a ton on new equipment right now, while other rules made it easier to take on debt to expand. The whole incentive structure of the market shifted away from that slow and steady safety and towards aggressive, homegrown growth. And you want to see where this shift was just off the charts? Look at the utilities sector. Utilities used to be the most boring, predictable widow and orphan stocks you could possibly own. But now, thanks to the insane energy demands of artificial intelligence, they've become these racy growth stocks. They're spending billions to build out infrastructure for data centers years before they'll see any revenue from it. This turned the safest sector in the market into one of the most speculative. All right, so if the old playbook is totally shredded, what do we do now? We need a new one. It's time to redefine what resilience really means for 2026 and beyond. The new way of thinking? It's all about the numbers, not the story. Instead of just trusting a company's reputation, analysts now look at hard data. A low beta, for example, shows the stock is less jumpy than the rest of the market. A high Peterosky F-score indicates really strong financial health. And that dividend payout ratio is absolutely critical. A company paying out between 40 and 60% of its earnings is in a sustainable sweet spot, unlike Walgreens, which was paying out way more than it could really afford. Now, if you're thinking, I don't want to be a stock picker, that's okay. There are these systematic strategies now to create what some people call synthetic safety. The quality factor basically screens for companies with the healthiest financials. It's designed to avoid the junk. Then there's the minimum volatility factor, which takes a different approach. It uses math to build a whole portfolio of stocks that, as a group, is designed to be as stable as possible when the market goes down. But here's a modern twist, a real head-scratcher for a lot of people, the ESG yield trap. As more investors focus on environmental, social, and governance factors, some of the highest dividend yields you can find today come from so-called sin stocks, like the tobacco company Altria. Now that 7+% yield looks amazing compared to a quality company like Procter & Gamble, but it comes with massive regulatory risk. It's a trade-off that really forces you to decide between high income and high uncertainty. So who are the good guys in this story? Who are today's tortoises that actually win the race? Well, companies like these. American States Water, Procter & Gamble, Coca-Cola, Johnson & Johnson. They're in sectors that people need no matter what the economy is doing. They have balance sheets like fortresses, and they have these incredible multi-decade streaks of raising their dividends, all while keeping those payout ratios sustainable. This is what the new safe looks like. So let's bring this all together. What's the big takeaway here? It's that the idea of a static buy-and-forget safe stock is dead. Safety today is dynamic. It's something you have to keep checking on. So let's look at how to build that financial umbrella for what could be a stormy 2026. So here it is, your new playbook boiled down to 4 key things to focus on. First, hunt for that sustainable 40 to 60% payout ratio. Second, find companies that are part of the modern economy, even in boring sectors, like the utilities that are powering AI. Third, and this is a big one, always prioritize a company's current financial quality over its history. And fourth, maybe look beyond just stocks to things like gold, which can give you a different kind of safety when markets get rocky. At the end of the day, here's what you need to remember. Safety isn't a destination anymore. It's not some stock you can just park your money in and forget about. It's a direction. It's a process you have to actively navigate. The only question left is, which way are you headed?